How can you earn a higher return on your cash without taking on too much risk? Where should you keep the money you are saving for a down payment on a home? And how do 401k contributions affect your take-home pay? We'll answer these questions and more on this, the 95th episode. Can you believe we're almost to 100? Of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, this podcast is sponsored by Betterment, the most preferred automated investing service. Betterment has cutting-edge technology to optimize returns, minimize taxes, and save you time and money. Join over 34,000 customers who have already streamlined their portfolio management at betterment.com/roller. That's betterment.com/ROLLER. Well, we got a lot going on today. I've got a couple of emails from folks that I'm going to share with you. One is the main topic of our show today. That is, where should you put your cash? Where should you put your cash for safety, but also to earn some income? Got a great question from a listener named Brian that I'm going to share with you. And then also got an email from Stephanie. You may remember Stephanie. She's the doctor that's learning to invest like a pro, as I put it. And we had her on the show in podcast 92. And she actually emailed me with a great tool that I wanted to share with you. So we're going to talk about that. Before we get to it, one thing that came out today was that the GDP in the spring was on an annualized basis up 4%, which is really strong growth in the United States. I mean, 4% is phenomenal, particularly when you think of the size of our economy. But of course, that's got folks asking questions about what the Fed is going to do and what they're going to do with interest rates. Of course, if you follow that kind of thing, and by the way, you're perfectly sane if you don't. But I follow it I follow it probably more than I should anyway. They're slowly ratcheting down their purchase of mortgage-backed securities and other bonds. I think they're down to $35 billion a month. I think. And they're heading to $25 billion. Eventually, they're going to get to zero, and then they're going to presumably start raising rates. And they tend to look at employment. I'm sure they look at a lot of things, but at least what they tell us, they look at employment or unemployment numbers and inflation. So with GDP, of course, as our economy grows, that hopefully has a positive effect on employment and brings the unemployment rate down. Hopefully, right? As more people find jobs, and then as more people are working and the economy is growing, prices tend to rise. So you tend to see higher inflation. So these things are very important as it relates to what the Fed is going to do. And so it'll be interesting to see how quickly they move, which is sort of the big question that the markets are asking. But, it's relevant to us, too, because it affects everything from how much interest we earn on the savings account, which will be part of the topic of today's show, to what interest we pay on a mortgage, the interest we pay on a car loan. So it if you're in retirement, of course, it can have a huge impact as you're trying to find sources of investment income. It affects the pricing of annuities. It has a huge impact on you and me. The everyday kind of stuff, and so it'll be interesting to see how that plays out. But that was just announced today, so I thought I'd share it with you. And it relates to the topic we're gonna talk about today. Before we get to that, though, I wanted to share with you an email that I mentioned that I received from Stephanie. And she was I won't read the whole email, but basically she wrote in. She was listening to some of the podcasts and talking about specifically the one on whether you should invest in a Roth or a traditional or non-Roth 401k, or for that matter, some combination of the two. I stress this so often. It's not all or nothing, right? Most personal finance and investing decisions aren't all or nothing, but sometimes I think we kind of get into that rut of thinking black and white, right? I take all my extra money and I either save it or I put it towards debt. Well, you could do a combination of both. The same is true with Roth, the decision of Roth versus traditional 401ks and IRAs. You could split your money up and put a little in both, right? But in the event, she was listening to that podcast. And by the way, if you haven't listened to that show, it's podcast 90. So DoughRoller.net/podcast By the way, one of the things she said was, she says, I really love that you show your math. Stephanie, I'm not sure you and I might be alone on that. I'm not sure how many other people like it when I dive into the math, but I think it's important, and I appreciate the comment. And if you listen or have listened to the Roth versus traditional retirement account episode, I try to lay out some of the math behind at least my thinking on that decision. But anyway, Stephanie continued on in her email. She said, it really got me to thinking about how I allocate my 403B contributions. I am going to do the math for myself later when I get home. But as I thought about this, I wanted to share a tool that I use and have found helpful, and it's called PaycheckCity.com. When I think of changing my federal or state withholding, or changing my 403B contribution, or changing my 403B from traditional to Roth, I use this calculator to determine the effect on my take-home pay. I have found that it is very accurate to within a few cents. There may also be other calculators like these, but I figured I would share with you. Thank you again for an excellent podcast. I look forward to listening for years to come. Wow. Well, Stephanie, I look forward to producing these podcasts for years to come. So I checked out the site she mentioned. Again, it's paycheckcity.com. Very easy to remember. They actually have a number of different calculators, and they look terrific. So you can, for example, if you're going to start making 401k contributions, you're going to start setting aside $500 a month, and you think to yourself, well, how's that going to affect my take-home pay? I know it's particularly if you're pre-tax, right? If you're contributing to a traditional 401k, you get some tax benefits from that. You want to know what they are before you make this decision. Well, Paycheck City has a calculator for you. They have what they call a salary calculator, which is just a more traditional way of figuring out, based on the number of withholding, the deductions, the withholdings that you have for state and federal, and your pay. And of course, it asks you what state you live in, because it's going to vary from state to state. It will calculate your take-home pay. And they have other calculators as well. They have a W-4 assistant, right? So the W-4 is what you fill out for your withholdings, the number of withholdings you're going to have state and federal. They have a calculator for that, and other things. So definitely looks like a great tool. Stephanie, thanks for mentioning it. I'm passing it along to everybody else. So if you want to give it a try, you can. Again, that's paycheckcity.com. All right, so on to the main topic of the day, which kind of relates, as I said, to the GDP and what the Fed might do and interest rates. And the question came to me from a reader named Brian. And I'm not going to read his entire email. By the way, I love getting these emails. Brian attached some spreadsheets that he has prepared. I'm not going to cover those, but of his finances. I got to tell you, these are tricked out spreadsheets. I'm not sure how else to describe. They're color-coded. They go back, I think, a decade. Phenomenal record keeping. And, you can just tell that he has given a lot of thought to his finances, a lot of thought to his future. He's married. And it's just phenomenal. And but here was his question. He provided some background, but at the end of the day, here was his question. He said this. He said, we have started a house fund. He and his wife have started a house fund, and it grows by about $250 every other week, so around $500 a month. It is in 2 savings accounts in Capital One 360. It now is currently about $13,000. I would like to move about $10,000 of this into a better growing interest account for the next 2 years, when we will be on the market for a house. What would be your suggestion of a safer, he had that in quotes, safer, low-cost account to have this money work for us? I'm hesitant to move it, as I need this money for a down payment and do not want to lose it. Any insight would be greatly appreciated. Well, that's a great question, and I appreciate that. And as I read his email, I realize that his name is Matthew, not Brian. I think Brian may be his middle name. Anyway, Matthew, thank you for the email and a great question, and I apologize if I got your name wrong. But it's a great question, and it comes up in a lot of different contexts. In Matthew's case, it's related to saving for a down payment for a home, right? But maybe you're saving for something else. You're saving for a child's education, and maybe they're going to be going to school soon. You're going to need the money in a year or two. Or maybe you're saving for a car because you want to pay cash for a car, and good for you. That's the way to buy them. Or kind of a related question I get a lot, and something I've struggled with, is where do you park your emergency fund? I mean, doesn't it kill you to put an emergency fund in a savings account that earns so little right now? And so the question, that Matthew asks, goes bigger than just saving for a home. It's really, what do you do with your cash? And but of course, in his case, it relates to buying a home. Now, it does matter what you're going to use this money for, right? If it's an emergency fund, the tricky thing with an emergency fund, of course, is you don't know when you're going to need it. You might need all of it tomorrow. You might not need it for 10 years, right? You don't know. That adds an extra dynamic to the whole question. But in Matthew's case, he knows he's going to need it in 2 years. So what I want to do today, and part of my approach to answering questions like this on this show, I hope this has come through, but I kind of want to make this explicit. One approach is I could just say, okay, Matthew, you keep it in a savings account because that's the safe thing to do. And then I could say, okay, everybody, that's the end of the show. Leave it in your savings account. And I could even play my indie music. Yeah, there we go. And then we'd be done with the show. The problem with that, in my mind, is a couple of things. One is that may not be the best answer for everybody. I don't think most personal finance and investing questions have just one answer. The second thing is that, my goal here is not to try to pretend like I have all the answers and I know what's right. Every situation is different, and I don't know all the answers. If you listen to my episode about the $100,000 retirement mistake that I, and in fairness, my accountant made, you know firsthand that I don't have all the answers. Sometimes I get it wrong. So part of my goal is to kind of give you at least a framework for how I think through these issues. Now, the way I think through these issues may or may not be right for you. You may think I'm an idiot. I don't know. But I walk through how I think of these issues. And part of my goal is to kind of take these topics beyond just the specific question at hand, because really, I think we can build a framework for answering all kinds of personal finance and investing questions as we walk through these in hopefully what is a logical and reasonable way. So that's what I want to do today with Matthew's question. So with that, I want to start with a question for you. We know that savings accounts, and I guess also to some extent checking accounts that pay interest, some do, right? They tend to offer the lowest interest rates. Why? Well, I think one answer is probably obvious to many. One might not be so obvious, but to me, there's two reasons for it, and they are safety and liquidity. So let's talk about each of them. On the safety side, with a bank that's FDIC insured here in the United States, you have virtually no risk in losing your money as long as the amount is under the FDIC insured limits. Currently $250,000. There are actually ways to extend that with multiple accounts, but I'm guessing most of us don't keep more than $250,000 in cash. Maybe some of you do. You can email me with suggestions if you do, because I've actually looked at that issue. But I don't keep that much in cash. I don't think most people do. But so one of the reasons the rates are so low is because of the safety. Your money is backed by the FDIC insurance fund, and so if the bank were to go belly up, you would get your money back from the government. And there aren't too many investments where you have that kind of security, that kind of safety. But, there's no free lunch. Everything comes with a cost. One of the costs of that safety is low rates, right? That's the first thing. The second thing is liquidity. You can get at your money in a checking or savings account anytime you want with no fees, no expenses, no penalty fees for taking your money out. These are demand accounts. You can walk in, demand your money, and walk out with your money. And so when you combine these two features of your sort of traditional checking and savings accounts, safety and liquidity, you end up with very low rates. In fact, the rates are so low that they generally are less than inflation. That's certainly true today. Inflation today, I think, is around 1.5%. I know someone out there will correct me if I got that wrong. I think it's around 1.5%. And for banks, checking and savings accounts, you're not going to earn 1.5% today on your account. So what that means is that the purchasing power of your money left in a bank will go down over time. You are effectively losing money. No, you're not. If you start with a $10,000 balance in a savings account, you're not going to end up with $9,000. You're not losing money that way. But what your money can buy, that will erode over time as inflation outpaces the interest rates you earn on a checking or savings account. So in that sense, they can be quite expensive. But again, the benefit, safety, and liquidity, and both of those things are important to Matthew, right? He said in his email he doesn't want to lose money. This is money that he needs, he and his wife need for a home. So safety is very important to him. And liquidity, probably not quite as important to him. He doesn't need the money for 2 years, but that doesn't give him a whole lot of options, right? He can't lock this money away for a decade. That's not an option for him. Can he lock it away for 2 years? Sounds like he can. But then at the end of that 2-year period, he's going to need the dough. So what are his options beyond a savings account? And really, I want to speak to, we're going to look at kind of 3 things. The first is, to the extent your money's in a savings account, you want to make sure you get the best interest rates. Now, he mentioned that he has his money at Capital One 360, which is an online bank. It's where I bank. I have my savings account at Capital One 360 as well. So that's the first thing. We want to make sure that to the extent your money is in a savings account, you're getting the best rates. And for that, it's generally an online bank. Now, Capital One 360 is not your only option. Ally Bank, American Express, believe it or not, has a bank. Synchrony Bank, which I always have trouble pronouncing that. Synchrony Bank, I hope I've got it right, is another good one. And if you want kind of, what I do is I keep track of these interest rates on my site, and I update a post every month that lists the highest rates for checking, savings, CDs, the longest term balance transfer cards, mortgage rates. And I update it every month. If you want to go to it, you can just go to DoughRoller.net/rates, RATES. That will direct you to that page. What that page will do is give you some specific banks where I found the highest interest rates, but it'll also give you links to other pages on the site where I have tables of whatever, checking accounts, CDs, savings accounts, and you can see what's out there. But by and large, the online banks pay the most. They don't all pay the same amount. Some do have minimum requirements. Most of them don't have fees to speak of, but it is important to look at those details. So to the extent you're going to keep your money in a savings account, you obviously want to get the most you can. So that's why I have a Capital One 360 account. My checking account is with Citi. The problem there is on savings accounts is their interest rates are just awful. The online banks have the higher rates. So to the extent I have a savings, want to put money in a savings account for emergencies, I move it over to Capital One 360. By the way, one of the things, and I don't think, in fact, I'm going to look up my article on rates. I actually don't think Capital One 360 has the highest savings account rates at the moment. And I'm looking this up as I go through this. So you may be saying, well, why do I use Capital One 360 if it isn't the highest? Well, part of that comes from the fact that I had an ING Direct account, the orange account years ago, and Capital One 360 or Capital One bought them and renamed it Capital One 360, and I've just kept it there. But the other reason is Capital One 360 has what's called a money card, and it's for teenagers and young adults, and both my children use this money card, which we've just found to be phenomenal. It's basically, a debit card. They can get direct deposit from their paycheck into the account. I can transfer money to their accounts if I need to. That's usually, so, and I think I may have mentioned this on a previous show, but that's actually been very helpful to us. However, all that being said, if you're just focused on your money, Capital One 360, as of today, end of July 2014, for their savings account, I'm looking at my site now, 75 basis points. Remember, 100 basis points is 1%. So 75 basis points would be 0.75%. We tend to talk in basis points because it's just easier than saying things like 0.75%. Anyway, that's Capital One 360. Synchrony Bank is actually 95 basis points. And Everbank, which is another one that I mentioned on my site, actually they have 101 basis points, but they do have a minimum of $1,500, and that's a bonus rate. The rate actually comes down a little bit after a year or 6 months, I think. So there are different options. Ally Bank is 87 basis points. GE Capital Bank is 90 basis points. Actually, on my list, it's funny, on my list, Capital One 360 is actually the lowest. I don't know. Maybe I need to switch. Anyway, the point is, if you're going to the extent you're going to keep some of your money in the savings account, you obviously want to get the best rate you can, or at least one of the best rates you can, and that's generally going to be an online bank. And so again, you can go to DoughRoller.net/rates and you'll see all of this. And then it has links to pages that list various things like checking and savings accounts and CDs. So that's the first thing. Now, obviously, Matthew, I think, wants to go beyond that. And so the other two things we're going to look at is safety and liquidity in other types of investments. And so what we'll start with is a certificate of deposit. Now, let's walk through. Now, not all certificates of deposit are actually FDIC insured, which may surprise some of you. When you go to a bank, however, when you go to a bank like, again, we'll use Capital One 360 or Ally Bank, those are going to be FDIC insured certificates of deposit. There are some that aren't, and I'm going to talk about those in a minute. But let's focus first on what most of us think of as traditional CDs at a bank that are FDIC insured. So how does the safety liquidity equation work here? Well, safety is the same, right? They're just as safe as a savings account. They're FDIC insured just like a savings account is. Again, we're assuming we're talking about CDs that are FDIC insured. They're just as safe. It's the liquidity side of things that starts to change because, as you know, with most certificates of deposit, you have to lock your money away for a period of time. And while, yes, you can get at the money, if you take it out too early, you are typically charged a penalty, right? And so that encourages you, of course, not to take your money out earlier. So you do get this. It's not a huge liquidity difference. You can still get at your money, but you've got this penalty. Now, in Matthew's case, one option, of course, would be to put his money in a CD that matures in 2 years, right? So assuming that nothing changes with his plans, he would have his money in 2 years, wouldn't pay a penalty for it, right? Would take it out when it matures. So you've got your safety check. You got liquidity issues, but one that you can manage. Now, unfortunately, a 2-year CD, FDIC insured CD, doesn't really offer much higher interest rates. I'm looking at Ally Bank, for example. They currently are paying 110 basis points, 1.1% on a 2-year CD. So not it's slightly more, not a huge difference, unfortunately. And by the way, if you were to just jump out to like a 5-year CD, for example, let's see what we get there. If you go to my CD page, and you'll find all this if you go to DoughRoller.net/rates, there's a table, and you can adjust the term, the account type, the amount. So when I do that for 5 years, Synchrony Bank pays 2.25%. So, of course, more, but you're locking your money away for 5 years. That obviously won't work for Matthew. So a CD is a potential option, but at least at the moment, the interest rate's still, for a 2-year CD, not great. Now, there is one other risk with a CD. Let's assume that Matthew said, okay, it's not a lot more money, but fine, it's a little bit. I'll put it in a CD for a 2-year term. And then 6 months from now, with the GDP going up like we talked about, maybe unemployment comes down, inflation starts to rise, the Fed stops its crazy bond buying scheme and starts to raise rates, and all of a sudden in 6 months, instead of earning 1.1% on a 2-year CD, you could earn 1.5%. Well, Matthew's kind of out of luck, right? He's stuck because he's put his money in a 2-year CD. Yeah, he could take the money out and pay the penalty, but the penalty is probably going to wipe out any benefit from doing that. Now, so that is a risk with certificates of deposit that you should keep in mind. There are some CDs that try to deal with that risk, and Ally actually has one, and it's called a raise your rate or rising rate CD. The idea is that, yes, you lock your money in for 2 years in this case, but you get one option, one time you can raise the rate. If the rates go up, you can once during that 2-year period say, hey, I see that rates have gone up, I elect for that new rate. Of course, once you do that, whatever that rate is, you're now locked in for the remainder of the term of the CD. But it is an option, something to think about. Now, I'm looking at Ally's Raise Your Rate CD. That's what they call it. That's just the term that Ally uses. And for a 2-year Raise Your Rate CD, they only offer these in 2 and 4 years, by the way. It's currently 1.1%, 110 basis points, the same as just a 2-year CD. So you could put your money in that, and then if rates do go up, of course, then you have to decide, well, the rates go up to 120, 130 basis points. At what point do you pull the trigger and say, okay, I want to raise my rate, because you only get to do it once? Boy, it's just amazing the questions we have to answer sometimes in personal finance, but there you go. So that's an option that deals with the risk that interest rates will rise. So certificates of deposit, an option. Again, though, you ain't going to get rich. Interest rates are a tad higher than a savings account, but you do get that safety, and you can manage the liquidity issue. So there you go. So what else do we have? Well, we could go to U.S. bonds, right? They sell bonds, very short bonds, bills they call them. They sell the treasuries, the long bond, right? You could 30 years. That obviously won't work for Matthew. But you can buy a 2-year bond, T-bond they call it, right? And I'm looking on the website now, which is treasurydirect.gov. That's where you can go in and buy a bond directly. I've done that. I buy I-bonds through Treasury Direct, or I have one at the moment. So, you could go in. They have what they call bills. Those are short-term T-bills, right? Those are really short sometimes, 4 weeks. They have 13-week T-bills, 26 weeks. So very, very short. They have notes, and that's what Matthew might be interested in. Those are terms of 2 years. Let's see. They have 2 years, 3 years, 5, 7, and 10. Of course, you could go to what they call the bond. The bonds, those are 30-year bonds, but that obviously won't work for short-term money. So what would a 2-year T-note look like? Well, I'm looking at recent auctions, right? These are all sold at auction. And a recent 2-year auction, let's see here, it's going to be issued actually tomorrow, and its current interest rate, 50 basis points. That's lower than a savings account. The yield comes out to 0.544%. So let's first just talk about what this means. You have safety, right? It's backed by the U.S. government. It's considered a risk-free investment in terms of your risking your principal. Safest investment on earth. Now, by the way, that doesn't mean that the day couldn't come where it lost that safety rating, but at least at the moment, it's considered the safest investment in terms of protecting your principal. And you can buy the bills, notes, or bonds at whatever at numerous different durations. So you could handle the liquidity issue by buying the 2-year note. Now, we've talked somewhat about bonds. We do know that if something were to happen and you needed to sell a bond before it matured, so let's say you bought a bond, you invested $10,000 into and I'm using the term bond now just generically, $10,000 into a bond, and we'll just use the 2-year rate. You were earning 0.5%, not very good, but that's what you're earning. And then interest rates doubled. They went from 0.5% to 1% for this same 2-year bond. And for some reason, you wanted to sell. Maybe Matthew decided to buy his house early, found a great home, he wanted his money. Well, he wouldn't get par value for that bond. He wouldn't get his $10,000 because why would someone want to buy his bond and earn 0.5% when they could go out and buy a brand new U.S. government, in this case a note, they call it, but a T-note, and earn 1%? Why would they buy Matthew's and only earned 0.5%? So in order to encourage someone to buy his note, his bond, he would have to lower the price something below $10,000 to make up for that 0.5% difference between what his note was paying and what someone could get with a brand new U.S. note today. So there's not risk in the principal in the sense that they're viewed as riskless from a default perspective. But there is risk, and significant risk, if interest rates were to rise and you were to need to sell that note. And by the way, even if you didn't sell the note, you're still losing the opportunity cost of that higher interest rate, right? That's why we go back to that CD from Ally, that raise your rate CD. You kind of deal with that interest rate risk, at least in part, by having the option of raising the rate to the current rate one time during that 2-year period. Well, the U.S. government doesn't give you that option. Neither does the bond market. So there is some safety issues to think about with bonds. Again, the safety in U.S. bonds is not that they will default. That's not the issue. The issue is interest rates could rise, and you will either sell the note and lose money because you'll have to discount the note or the bond to make up for the lower interest rate on that note or bond, or you just lose the opportunity cost. You could have invested in a newer note and bond that was paying higher interest. So interest rate risk is I think the biggest, certainly even at investment grade bonds, corporate investment grade bonds, the interest rate risk is the biggest risk to bonds in my view. All right. So, but it is an option. Now, in this case, of course, Matthew wouldn't go with that because the interest rate's so low. You just keep your money in a savings account before you'd buy a 2-year note that's paying 50 basis points. This doesn't make any sense. But I wanted to mention it. Rates change, markets change. Maybe down the road, these would be better options. Okay. What's our next option? Well, we could, rather than buying an individual bond, we could invest in a bond mutual fund. And so that's one option, right? And the problem with that is, let's talk about safety and liquidity. So the safety depends on what the bond mutual fund invests in. If it's investing in U.S. issued bonds, it's just as safe as investing directly in the U.S. issued bonds, right? That's on one side. On the other extreme side, there are bond funds that are extremely risky. What they call high yield or junk bond. These are funds that invest in corporate bonds where the corporation's credit ratings are below investment grade. In other words, they have a higher risk of default. So those kinds of bond funds can be very risky. Emerging market bond funds, foreign bond funds, can be extremely risky. I mean, they can be as volatile as the stock market. In some ways, some of these funds act more like stocks than they do bonds. But if we focused on a bond mutual fund that invested in U.S. bonds and maybe other investment grade bonds, is there risk of default in those cases? Yes, but it's minimized. It's not the same as a junk bond, high yield bond fund, or say an emerging market bond fund. The question then you'll have to answer for yourself is, are you willing to take that risk? The other risk as relates to safety is, as I mentioned, interest rate risk. If interest rates go up, the value of your bond fund can and will fall. Now, how much it falls depends on what's called the duration of the bond or the bond fund, something that I'm going to cover in more detail in another podcast. But I'll just say this. You can look up a bond fund. In fact, let me just pull one up. I'll pull one up that I invest in. We'll look at the Vanguard Total, no, not that one. Here we go, the Vanguard Total Bond Market Index Fund. I'm going to pull it up in Morningstar. And so what is this fund? Vanguard Total Bond Market Index Signal Fund, VBTSX. I actually own this through my 401k at Fidelity, oddly enough. It's trailing 12-month yield. So TTM, trailing 12-month yield, or think of it as your interest that you're receiving, 2.59%. So that's significantly higher than a savings account. So that's the good news. The bad news is if interest rates go up, you can absolutely lose money in a bond fund without question. The value of your money can go down. And in this case, the interest rate risk is considered moderate. So it has what's called an effective duration of 5.62 years. What the heck does that mean? Well, I've talked a bit about duration and maturity. They're different, but they're related. I'll just say this. If interest rates were to go up by 1%, and by interest rates, think of the long bond, the 30-year bond, U.S. government bond. If that were to go up by 1%, or the 10-year bond, the value of this fund would go down by a percent equal to its duration. So its duration is 5.62 years. If interest rates went up by 1%, the value, my investment in this fund would go down by 5.62%. So if you follow all that, and I know it's a little confusing, the longer the duration, the more you'll get punished if interest rates go up. By the way, the opposite is true too. The longer the duration, the more you'll earn if interest rates go down. Right now, the environment we're in now is interest rates are at historic lows. The odds of them going down, at least significantly, and for a prolonged period of time, not great. I know this is a lot of detail, probably more than you want to get into when you're just saving for a house. So for a lot of people, I understand if you cross bond mutual funds off of your list. But one option, if we want to look at this in a little more detail, is to go with a shorter term bond fund. Because again, remember, the shorter the duration, the less impact rising interest rates will have on your investment. And certainly Vanguard offers, as most mutual funds do, shorter-term bond funds. One example is the Vanguard Short-Term Bond Index Admiral Fund, VBIRX. It has a shorter term. Its duration is just 2.7 years. So a rise in interest rates of 1% would lower the value of this fund, all other things being equal, by about 2.7%. Now, With shorter duration funds, though, your yield goes down. The trailing 12-month yield on this fund is 1.14%. Not much better than a savings account. So I mention this as options. By the way, at the end of this, I've got a few more options to mention. At the end of this, I'll tell you what I would do for what that's worth if I were in Matthew's situation. But I kind of want to work through all of the options. So this bond mutual fund is an option. Again, it's got risks as I've laid out, and its yield is not much greater than a savings account, and it's only 4 basis points better than the 2-year CD we were looking at Ally. So you can probably figure out where I would go is between these two choices, but I'll come back to that in a minute. Got a couple more things I want to throw at you. The other option, a REIT, real estate investment trust. These tend to throw off a lot of income because they have to distribute, I think it's 90% of their earnings to the shareholders. So they throw off a lot of income. And the yield, I'm looking at the Vanguard REIT Index Admiral Share. It's a fund that I own, VGSLX. It's trailing 12-month yield, TTM yield, 3.06%. So now we got a little bit bigger number. It's earning 3% yield. That is much better. Liquidity is going to be fine. You can buy and sell into this fund when you want. I will say that with any mutual fund, one thing you do want to look at is some funds will charge you fees if you trade too frequently. And so that's something to think about. But assuming it doesn't, then liquidity, you can pull your money out whenever you want. The safety is the problem here. A REIT fund, like a stock index fund, could absolutely go down. Their yields are usually very attractive, but they can go down, and they can go down significantly. For example, this fund, which I've owned for a very long time, if you invested in let's see, 2004, $10,000, that investment would have risen nicely to about $20,000 by 2007. And then remember the housing crash? By 2009, early 2009, it would have plummeted to $6,500. At that point, most people would have sold. Had you not sold, though, hopefully because you listen to this podcast and you have an asset allocation plan and you stick to it, today that $6,500 would have grown to about $26,000. But the point is, it's a very volatile, rocky, roller coaster kind of ride. And I think in Matthew's case, not one that he wants to take. But I do mention it, REITs do offer nice yields if you can handle the roller coaster ride. If you're really short term and you need your money soon, probably not a good option, but I mention it because the yields are good. Okay, the last two options are related. Dividend-paying stocks and dividend-paying stock mutual funds, they're going to have the same issues for Matthew that a REIT fund does. You can find a good stock, a stable company that pays 2, 3, 4, 5% yield. Quite good. The problem is, and liquidity is going to be fine, right? You can sell these shares anytime you want in the market. It's the safety issue. The problem is, you could, even if the company continues to pay its dividend, and even if it continues to increase its dividend, you could see the stock price go down, or a stock mutual fund, the value go down significantly for a prolonged period of time. Now, there are certainly some investments in some companies that are less volatile than others, and some industries that are less volatile than others. But particularly if you need your money short term, probably not a good option. For me, I keep a lot of what you might consider my emergency fund in stocks and stock mutual funds in my taxable account. Now, I do keep cash as well, but what I've found is once I've invested long enough and based on what we have and we have very little debt, I'm very comfortable doing that, knowing that over the long term, I'll be just fine. And so most of my investments, in fact, all of my stock investments except for Berkshire Hathaway, pay a dividend. And actually, I'm preparing a series on dividend investing, and I'm going to have probably 2 or 3, maybe 4 shows on dividend investing. I think it's a great, fun topic and very important for building your wealth. For Matthew, probably not what he's looking for. So where does this all leave us? At the end of the day, unfortunately, at least in my view, if I were making this decision, I would view it as having very, very few options. I wouldn't put it in a REIT because it could easily be down 2 years from now and I could have less than the $10,000 I started with. Same is true with a dividend-paying stock or dividend-paying stock mutual fund. I would consider a bond, normally a short-term bond fund. I might be willing to take the risk on a short-term bond fund that interest rates could erode some of the value of the fund in exchange for higher returns. The problem is the short-term bonds that we looked at, the T-notes, they're paying 50 basis points. That's terrible. The short-term Vanguard bond fund, it has a trailing 12-month yield of 1.14. So why take that risk? I can do a 2-year CD at a place like Ally, for example, and basically not only get the same or roughly the same yield, but I can do a rising rate CD and elect to increase the rate if rates should go up over the next 2 years. So if the decision if I were making this decision for me, I would probably look at a 2-year certificate of deposit, one where I could, but I'd want one that had the rising rate feature, because I do think there's a reasonable chance that interest rates will rise over the next 2 years, and I wouldn't want to be stuck at 1.1% if, a year from now it's 150 basis points. Who knows? It could be even more. So that's probably what I would do. And if as a second alternative, I would just stick with a high yield savings account. I know Matthew's looking for something that pays more than that. Probably you could move to a savings account that pays a little bit better than Capital One 360, like the ones I mentioned, and you can check those out at DoughRoller.net/rates. But to me, if I needed that money 2 years from now and it was for a home for my family, I wouldn't risk it. I wouldn't risk losing. I just wouldn't give up the safety, and so there are not a lot of great options. Oh, and by the way, one last thing. I realized that I forgot to mention the non-FDIC insured certificates of deposit. Believe it or not, there are plenty of certificates of deposit out there that are not FDIC insured and pay higher rates as a result. In fact, I know there are a lot of charitable organizations where you can effectively invest in a certificate of deposit. The charitable organization will use that money to finance their activities, but they're not FDIC insured. Now, you tend to get higher interest rates. If a 2-year CD is at 1.1% now, you might get 2% on a CD that's not FDIC insured. Again, but you're giving up safety, right? You might not get your money back or all of it, and if you don't, the government's not going to be there to bail you out. So again, there's always trade-offs. So in this case with Matthew, I would be focused on safety, and I might give up a little liquidity with a CD, but if I stuck to a 2-year term, I know I'd have my money when I needed it, although it would erase some options for me. If something changed and I wanted to buy a home a year from now, I might be paying a penalty to take that money out, so that's something to consider. So that's how I think through those issues. Again, it all comes down to safety and liquidity, and the more flexibility you have in terms of when you need your money, then the more risk you can take. If I didn't need the money for 10 years, I would absolutely have it in a combination of stocks and bonds, or stock and bond mutual funds, or at least a good chunk of it. Of course, I'd have to confront this decision eventually as I got closer and closer and closer to that 10-year mark when I would need the money, and I'd be shifting some money out at appropriate times to more safer things like a savings account. But unfortunately, those are the options you've got. None of them are pretty right now in this current interest rate environment. I've kind of walked through how I think through these issues. I've walked through the options that you might have. Ultimately, it kind of gets me back to where Matthew is already, a savings account, high-interest savings account, or possibly a 2-year CD if you can do the rising rate kind of thing that protects you, at least to some extent. Again, you only get one chance at that. You only get to raise your rate once, but it protects you should interest rates rise. That's what I would do. Hey, if you're listening and you have other suggestions or other ways of thinking about this or other alternatives that you might consider, let me know about them. I'd be happy to share them in a future episode, dr.doughroller.net. The other thing I want to mention is, we're coming up on the 100th episode, and I've got something special planned. I'm not going to tell you what it is, but I will say this. If you have questions that you'd like me to answer, if you have comments about the show, you want to tell me how great the show is, you want to tell me how bad the show is, email me, and do it soon, because your emails may end up on the 100th episode of the DoughRoller podcast. Kind of hard to believe we've come that far in such a short period of time. It's been less than a year, and I'm about to hit number 100. So yes, definitely send me those emails, dr.doughroller.net. You can check out the show notes of this episode, doughroller.net/podcast95, podcast 95. And as I mentioned In terms of all the interest rates and things that we've talked about, you can just go to DoughRoller.net/rates. That's a page that I keep updated every single month. Hey, appreciate you listening today. Hope you have a great day. Until next time, remember, the best thing money can buy is financial freedom.